Hello, everyone. Hope everyone can hear me. We are happy to have you with us today. Thanks for taking the time from your homes. First, hope everyone and your families are safe in your homes and healthy as we're all learning to live in kind of a new environment here. Thanks I'd like to thank all of you as clients and the trust and confidence that you place in us for years, and especially in difficult times like this. I'd also like to thank all of the team at Exencial, the advisors, the investment teams, the operations people who've been working tirelessly. We've talked with many of you over the last several weeks, in the mornings and the afternoons, evenings, emails, Zoom meetings, weekends, and we all share a lot of the same concerns as we're figuring out the new world that we live in. So clearly, the world is a different place than what we knew or were experiencing or could really even have imagined just a couple of short weeks ago. As we think about where we are today, first and foremost, we're dealing with a virus that's affecting how we live, work, and play. We have some fear for our own health, just as importantly, the health of our friends and neighbors in our communities and around the country. Secondarily, we are experiencing a completely self-induced economic crisis as well, and it's all for good reason. First and foremost, we're here to protect each other and our health, and then secondarily to figure out the back end of that. And so there's some very unique, unprecedented issues really around this particular crisis that we've faced. We've faced many over the years, and each one of them have different nuances, different reasons for why they started. But the one thing that remains a constant is that we've always overcome them. And while the future is a little bit uncertain and exactly how that may come about, I think we can look to some confidence that we will get through this one as well. And with that, it takes a couple of key ingredients. It takes some resolve. It takes resolve from our leaders, and it takes resolve from each one of us. And it takes a sense of purpose, that there's a greater good than any one of us, and that we can all pitch in and do our share, do what we can do to make it better for ourselves, for our friends, for our neighbors, for our family, for our community. And there's something that we can, all of us, do. For the most part, I think we've been doing what we can do, which is stay at home, be aware, learn about what's going on and how we can contribute. If there's some things that we can do in the community, certainly recognizing people that are making a huge difference on our behalf, having more gratitude, and the like, all of that is going to be beneficial. As we think about that, I think it's also part of that resolve is really understanding that as we face the next several weeks and months to come, we're likely going to start experiencing this in a much more personal way. So at first we're learning about the coronavirus, and it was kind of out there, and we're watching numbers of people that were infected in countries elsewhere, or communities elsewhere. And now we're starting to see that it's coming and it's going to be here. We need to be prepared for that mentally. It's not going to be easy. but it's likely to affect each and one of us in a very personal way, friends and family and loved ones. I can only speak for myself. I have a friend that's fighting for his life now, um, and it's hard to imagine that. But we have to be ready for that and try to get ourselves prepared. It's going to be very difficult. Um, Along with this is um, the economic impact is severe. It's immediate, and the exact depth of that is really unknown at this time. Um, but we will get through this as well. And you're already starting to see some of the steps as we continue to watch leaders in government, healthcare professionals, private sector. Everybody is starting to get organized and preparing to deal with a pretty major effort to keep people healthy. And the next month or so seems to be the most important element as we talk about a flattening of the curve that I never, even before this, really understood what that meant, what it is, how important it is. But that's the first step, and hopefully we're well on the way. A friend of mine sent me a quote during this week that I found kind of states it all, and in it says there are decades where nothing happens, and there are weeks where decades happen. And truly, over the last several weeks, I think that describes what we're all feeling and dealing with and coming to grips with as individuals and families. Secondarily, we're going to see some really bad economic news. We're going to see bad numbers coming later this week. We're going to start seeing the impact of people being laid off, unemployment numbers, and it's going to be severe. And it's going to continue to be severe for a period of time. I've talked with many business owners over the course of the last several weeks. I've talked with bankers. I've talked with individuals and employees that are affected. And it's very difficult. Each one of us are affected in different ways. Some are truly, trying to just keep food on the table and take care of their families. Others of us are feeling other severe economic impacts. They're all painful, and they're all things that we can get through. It's just getting everything working together. While this crisis is very unique, in some ways, the cures, I think, are knowable. It's first getting the health under control, and it's simultaneously keeping the fabric of our economy intact and not make it structural in nature. That's certainly going to take a big government push, as well as private sector working together to do that. We started seeing the effects in liquidity really last week, and Tim and Rich and Dave and team will talk a bit more about that. I might give one parallel relative to 2008, the last major financial turnaround that we saw, but this crisis is much different. One, it's self-induced. I think we learned a lot from that one. The key ingredient here is keeping families with some liquidity, businesses with some liquidity, and not letting it turn to solvency or insolvency. And so we're seeing both money in a variety of different formats, with the bill getting passed just and approved kind of last night and this morning. And then we're going to need to see some behind the scenes regulations that will allow banks to work with their clients. Lots of regulations make that very difficult on banks with the capital requirements that they have and just the inability to do that. And so it's going to take a lot of action so that they can actually help their clients. It's a major crisis. We're all going through it together. It's something that we will get through. And we just have to have some level of optimism and understanding that we've been through a lot as people, as a country, and we will get through this one as well. I'd like to turn it over to Tim at this point to talk a little bit about what we've seen over the last several weeks, the challenges, and certainly some opportunities as we get through this period of time and look towards the future. So again, thank you, and hope everyone is safe, and appreciate all of you. Thank you.
Yeah, thank you, John. Just a couple of real quick items of house cleaning before we begin going over our materials. As we're talking about performance today, performance is not indicative of future results, and we certainly hope that the recent performance is not indicative of future results. And as we're talking about strategies and particular investments, obviously know that these are not specific recommendations made to any one of you, but you should contact your advisor and speak with them about how this might make sense for your strategy in your portfolio, or how it might need to be looked at in a different way or at a later time. So welcome everyone to the call. I'm Tim Courtney. We're going to be speaking with Rich Irwin and David Yepes in just a few moments as well. I'm going to cover some broad market and economic data, and then Rich and David will cover some items related to the business cycle that we're in, and maybe what we might be looking forward to for the next several months. Also, I'd like to ask you all, if you do have questions, we're going to try to leave about 30 minutes to answer questions. And so if you would, please email any questions you have to Amy Black, who is the head of our trading operations. Her email address is ablack@exencialwealth.com, and she'll be gathering up all the questions and then asking those at the end. So please, as you come up with those questions, email those in to Amy. I appreciate that. So this has been, I think, the quickest bear market that we have had on record. You can see here some examples of some other bear markets that we entered into in 1987 and 70. Obviously, the recent ones in 2000 and 2007, which took several years. We did this basically in a month. And we see that reflected in equities across the globe. The S&P 500 was down over 30%. The Russell 2000, which are small companies, down over 40%. And then internationally, we see similar returns. The EFI down about 30%. Emerging markets down almost 30%. Energy has been hit particularly hard, and we'll talk maybe briefly about that sector later. They have a lot of challenges. Even at current pricing, energy has a lot of challenges. That was down close to 50% in the last month. And then REITs, real estate, has also been down, actually more than the market, down 40%. There's reasons for that. Even though interest rates are very low, there's a lot of concern about how real estate's going to be able to hold up post this virus. As more and more people are working from home, there's a lot of uncertainty about just how many square feet of office space we might need. So you're seeing a lot of dislocations occurring in the REIT and real estate markets. Also, over the last several weeks, we've seen that same kind of volatility spill over into some bond markets, into fixed income markets, even to areas that you wouldn't really even expect, like short-term, high-quality bonds. Even some money market instruments for a few days there were many stories about money market instruments. We'll talk probably about that as well today. But high-quality bonds have fallen between 5 and 10%. You can see municipal bonds down 7%. High-yield bonds, or lower quality bonds, are down between 15 and 20%. Government bonds have tended to hold up better, and they're probably close to break even. And so much of the concern now in the bond markets is how long are we going to be in this state of quarantine and kind of stopping normal business operations. That's one thing the market is concerned about, because we are a country that runs on credit. At the personal level, we use credit for homes and cars. At the corporate level, we use credit for expansion. And at the government level, we use credit. It's both federal and municipal. And going months without revenues, you will start to see some defaults occur. And that's what the market is really concerned about, is how long does this last, and what kind of insolvency or potential defaults are we looking at? I think that's the primary risk that the market's concerned about right now, is how long does this last? We are in recession right now, and estimates are for the first quarter, potential pullback of maybe 5% annualized pace. The second quarter looks very bleak. We would see pullbacks, estimates are in the 10% range to the 20% range. Probably most estimates are for the 10% range. We haven't seen a 20% annualized pullback since the Great Depression. But assuming, again, that this lasts weeks or months, this would probably not affect the third and fourth quarters, and most estimates for those quarters are for flat growth or potential slightly positive growth the later half of this year. We're still looking for a timeline and data on the infections. And so as we get more data, we'll know more, and the market will start to factor that in. So those are the primary risks that are being priced into markets as we speak. The factors in the recovery are, there is going to be deferred compensation, deferred consumption later this year. You will have people deferring trips, deferring purchases. And so you will also see inventories start to be rebuilt. Inventories today are actually fairly low. And so there will be some growth towards the later part of this year as business starts to pick back up. Markets typically trough in the recession. The market starts to recover even while we're in recession. And so while we don't know what the bottom is, it's likely that while we're still hearing bad news and still hearing bad reports, the market will hit its bottom and start to recover. We have fiscal stimulus along the way, about 10% of our GDP. That was announced yesterday. About 2 trillion, maybe a little bit more than 2 trillion in stimulus is on its way to try and counteract that -10 to -20% expected hit to the GDP in the second quarter. Valuations are difficult right now because we don't know what earnings are going to look like over the next several quarters. Companies are going radio silent for the most part. They are not issuing guidance as they normally would because it is unknowable. And so I think most companies are saying we probably will have a pretty sharp drop off in earnings in the second and third quarter, or the second quarter, and then gradually increasing in the third quarter and picking up steam in the fourth quarter. So it's hard to tell where we are with valuations, but on a trailing 12-month look, we're sitting right now at about a 16 price to earnings. If we look at forward, assuming a pretty good cut in earnings, we're probably somewhere maybe in the 20 to 24 PE range, which is about where we were when we ended 2019. So even with those earnings cuts, we're probably sitting at about a 20 to 24 PE, which is kind of the same ballpark we've been in over the last several years. The good thing is, though, that these earnings reductions won't be permanent. This is a health crisis. These are temporary, and the earnings declines that we'll see in these coming quarters will also very likely be temporary. So a few potential actions that we might look at taking is for us to review our fixed income and preservation assets. In some cases, it may make sense to take some of the riskier fixed income and sell some of that to buy higher credit quality and less risky bond fixed income preservation assets. We would do that now because that's one area of risk. Again, we still don't know really what the default totals will end up being after all this is said and done. So it may make sense to take this opportunity to buy higher credit quality bonds. On the other hand, if you have sufficient liquidity and you have enough money in your preservation assets, your fixed income side of your portfolio, it may make sense to sell some of the higher yielding bond assets or higher risk fixed income and use that to start to buy some equities. We're down 30% from peaks. That's a rare decline. We don't see 30% declines very, very often in these markets. And so that's an opportunity to buy some assets in the equity side relatively inexpensively, and doing that with some of the higher risk assets that we have on the fixed income side. We think because so many areas of the market has been hit, we think a recovery will likely be very broad, and that most stocks will participate in a recovery overall. That includes international stocks, it includes US stocks, small cap stocks across the board. We do think that certain sectors that are more they're more sensitive to to the economy, like financials and industrials, those very well may lead the way out. There are some sectors that probably are going to have difficulty. Like we said, the energy company likely needs to see some consolidation before some healing and recovery can happen there. And for some travel related names, if we see some consumer changing in consumer behaviors, it may be longer before they recover. And of course, as we talked about, real estate, REITs, office spaces, those we may see consumer behavior changes there as well. If we see credit spreads continue to widen, then we might find some opportunities in the high yield space. Right now, we're at about half the level that we were at in the darkest days of 2008. So some of these weaker credit names in 2008 have fell much more than the kind of declines we've seen so far. If we start to approach the level that we saw in 2008, we might find certain areas of the debt markets to look attractive again. And while we think that probably new purchases everywhere across the equity spectrum makes sense, we might want to have a majority of our assets purchased in US large caps, as they look like they're probably best positioned to weather the kind of disruptions we're going to see in the coming months. My last slide before I turn this over to Rich is just a note that markets look forward, and to think back to March 11th, March 12th, in that time frame when so many news items were coming at us all at the same time. Around the 11th and 12th, the NBA shut down, and then for the next several hours and next several days, so many things were canceled or delayed. So many organizations shut down. And since that time frame, since the 12th, the market has been moving up and down. We've kind of been in a fairly, certainly been volatile over the last week and a half. But we've stayed at about the level we were at when all of those news items hit. And that's just, again, to say that the market looks forward, and it probably was guessing or fearing that these things would be canceled and that we would start to shut down and we would go into recession. And as John mentioned, we are going to hear news stories over the next several weeks and months that are very poor, both on the health side and on the economic side. But markets are looking forward. Some or much of that is priced into markets, and we would think, again, before we come out of this recession, it's very likely, if history's any guide, that we would see the market start to rebound. We certainly could move lower from the levels we're at currently, but we would likely see the rebound occur before we start hearing good news out there. So with that, I'd like to turn this over to Rich Irwin, and Rich is going to talk about kind of the cycle that we're in and maybe things that he sees that we should and should be considering over the next couple of months.
Okay, hello everyone. I've been through a few of these before. I've been a professional investor since the 70s, and I've been through 5 of these downturns, severe ones, really severe ones, and we've come out of all of them before. And one thing that's common is everyone says, well, this one is different. Each one is different, and we wouldn't be down so far if it wasn't different and new and we hadn't experienced it before. investors hate, the thing they hate the most is uncertainty, and we have lots of uncertainty right now. But eventually that uncertainty resolves itself, and we need to be positioned to participate in the recovery. And it's very hard to time that to be one that gets out at the right time and gets back in at the right time. So the key, as I see it, is to, stay the course and to stay with good investments. This downturn has occurred in record time, as we've just heard, and we are very strong in our economy going into it. And there have been other instances like this where we've had sudden declines, and when the economy is healthy, typically we'll get some sort of fairly rapid bounce back. So anyway, that's just some top of the mind notes here. Looking at this slide of the cycle of market emojis, you can see that as things go up, people get excited and thrilled and euphoric, and then they start to get nervous as things go down and get into a high state of fear. We're probably at the panic stage. What the worst thing that you can do here is to, sell out a chunk of your account or all of your account, because these things turn rather quickly and it'd be very difficult to get back in at the right price, as was evidenced by the big rise.
Sorry,
yesterday.
Rich, can you show your screen? If people cannot see your screen, can you share it?
Okay, I thought I was. Thank you, David. Let me just see here. Okay. Sorry, guys. Somebody give me a hint when they see me on the screen. Not yet? It says I'm sharing.
You are sharing.
Okay, thank you. So this is the first slide, and I thank you for pointing out this where we are. So this shows that what I just talked about, the various stages of a cycle, and this is really the emotional aspects for the typical investor. And so we're now down at that low point, which is panic. And I haven't quite seen the anger yet, but we're certainly at the panic stage. But you can see that's toward the lower end, and then we begin to rise toward hope and optimism and so on. So, it's happened very quickly. These stages have just run through with great speed. That doesn't always happen. We had a downturn that took 3 years, and it just went on and on and on. But in this case, we're at that stage. We need to be very careful not to emotionally overreact. Okay, so I'm going to go quickly through this. Here's another picture of the cycle, and it shows you, this is a Fidelity slide, and it shows you what happens to stocks in a cycle. So for instance, when the recession, which Tim just said we're in, we ought to be more defensive, having more stable names and less of the economically sensitive names. And I might just, well, I'll say that in a minute. So also as we move, so here we are in the recession, but things are moving so fast, before you know it, we're going to be at the start of the next cycle. So we have to kind of find our way of participating in this part carefully, but then being open to moving into some of the areas Tim just talked about, financials and consumer discretionary and industrials. Right now, consumer staples and healthcare seem to be a good, safe place to be. So in Select, which is the area I work in, we pick individual stocks, we are making changes to be in these various sectors. We've gotten out of energy, we've gotten out of travel. We sold recently on Friday some of our more economically sensitive names and gone into ones that are more stable and predictable. Okay, this slide I thought was an interesting one from BlackRock. It shows cycles going back to 1979, and you can see that much of our focus in Select is on quality investments, companies that are going to last, companies that have good business models. And so as you look at this slide, you can see the quality investments, this is quality versus low quality. Anytime it's above the black line, quality investments are outperforming low quality investments. But there have been times we've had very speculative phases where too much debt was taken on. You can see back in the early 2000s, and you can see our latest period where pretty much quality has struggled to lead for the last 10 years. And now my experience is that with markets, that whatever is the leadership in one market, bull market, usually ends at the bear market, and then you have new leadership going into the next bull market. So this is worth watching. Our quality names have held up pretty well, but it is an area where you've been running against the tide, and we're likely to see that change as people pull in. Now, why would the lower quality have done better? Probably because debt was so available at such low rates. You could be a company that just loaded up your balance sheet with debt and you'd be doing fine, but not anymore. Okay, I have one more slide here to show you. This one is a little harder to follow, but we start at the bottom of it. It's the yield curve. And so what we're talking about is when the curve for treasuries begins to turn up. And why is that important? You can see that in past times, whenever that's begin to turn up above it, the stock market follows within the next year or so. And you can see these gray lines are the various bear markets, which correspond often with recessions. Those are the recessions. And we also have had bear markets like 1987, where we had a sharp decline, but then it came back rather quickly. So there is some hope here that if we start to see interest rates, perhaps because of the amount of debt that's coming into the market from the government, we begin to see interest rates go up a little bit, the stock market should follow, at least it has historically. So we have some optimism. We just feel we have to be well positioned. And I think the worst thing an investor could do is to not be ready for this recovery, to be out of the market and be scared out of it. It's not to say that I can guarantee it's going to go up, but history's showing us it will. Okay, well, I'm ready to pass that on to my cohort, David Yepes. Okay, so I will stop sharing here. There he is.
Thank you, Rich. Let me see if I can just really quick. So I'm going to focus on the healthcare area. And so I know many of you guys may have questions about this. So we're in the middle of a pandemic, and every pandemic has a beginning, a midpoint, and an end. If you go back to, the Spanish influenza of the 1920s, some of the Asian flus and Hong Kong flu of 1968, there was even a Russian flu in the 1970s. All of them have beginning, midpoint, and end. And so when we're looking at the data from the Asian economies, from China, South Korea, and so on, we're basically, I think, in our opinion, we're like in the midpoint. We're entering the midpoint of this pandemic. So what does that mean? That means that execution is the most important thing. Execution of our critical care healthcare system. We know that this virus, in some cases, it may develop into mutation, and it may develop into respiratory diseases. And people usually go to the emergency room, to the ICU, and they need ventilators. Some experts were saying that ventilators right now is like an atomic bomb. It's like having an atomic bomb in the last war, World War II. And so, it's critical care and I think, I'm focusing my presentation on just one slide because this is the money slide. If you look at the United States, per 100,000 individuals, we have 35 critical care beds per 100,000 people.
Your screen is not showing.
Oh, sorry about that. Let me see. Okay. Now, can you guys see it now?
Yes, thank you.
Okay, sorry about that. So if you look at the United States, we have close to 35 critical care beds per 100,000 of people, which compares to Germany, which has around 29. So we're in a better position in terms of critical care bed. And so if you look at some of the data from Germany that is coming out, it seems like, the death rates there in percentage of total cases is relatively low to the number of cases of people with coronavirus. So, of course, there are many things that are, affecting this: social isolation and some of how the governments react to things. So those are things that are out of our control, but it's also in terms of healthcare systems, we seems to be in a better position than other countries. Italy, if you see the numbers in Italy are awful. But one of the reasons is you look, it's at 12. So they have, we have 3 times more critical beds than Italy. Also remember that Italy has, the way the culture works there, people hug and kiss on the cheek, and some of the grandparents live with their daughters and sons. It's more of a family-oriented economy and country, and so those things, they're not doing. They didn't do the social isolation on time, I think, and so that's why they're having some problems there. One of the things that I'm hopeful for is that if you look at China, the number is at 3.6. And if you look at some of the data, if we believe the data that comes out of China is correct, there's some hope there, because, some of the commentary from companies that are in China, it seems like things are going back to normal, or at least 90%. And so if you look, the numbers on critical beds in China are lower than everybody else, yet the numbers in cases and death rates, they seem to be slowing down. So anyways, it's it's the next few weeks are going to be critical. The numbers definitely are going to get worse, but we are confident that we have the technology. Our companies, there are over 20 companies building vaccines as we speak. There are governments around the world investing billions and billions of dollars on this. Eventually, we're going to get a vaccine. And so hopefully we will be able to get this under control. So anyways, that's all I have. And I'll turn it over to Tim so we can start the question and answer session.
All right, thanks. Thank you, David. All right. So why don't we go ahead and jump into the question and answer session, and we're going to go up until noon and answer as many of these questions as we can. Amy has been cataloging the questions as you've been sending these in, and so we'll answer those, and those that we don't answer, we'll definitely get back to you with emails and get those responded to. So Amy, can you let us know what questions you have on the list?
Tim, yes, thank you. One of the questions asked is, it looks like governments are printing money. What do you think the ramifications of this will be in the long run? And is it more of a fiscal survival or a fiscal stimulus?
Yeah. So, currencies are driven ultimately by supply and demand. And over the last several weeks, what we've seen is that the demand for dollars has been very high. There's been a flight to safety. Investors have demanded dollars, and the dollar has risen. But we are about ready to flood the market with supply of dollars. I think that all of the things being equal, what that will likely do, and probably what most observers think will happen, is that the dollar will start to fall. The dollar falling has several benefits to global growth. It makes our exports, not as expensive. It helps other countries, which many times have to pay back their debt in dollars. It makes it easier for them to be able to hit those payments and get their operations up and running and make sure that they're fiscally in a better position. So I think the net result of this is likely that the dollar would move lower. And I think, and meet some of the demand, some of the huge demand that we've seen for the dollar in the last several weeks.
Okay, thank you, Tim. One of the other questions was asking if the dollar would appreciate, and since you said it could fall because of the printing of money, what would be the implications on that for our investments?
Yeah, I'll take an initial stab there, and then I'll open it up to the panel, get any of your thoughts. I think likely, it would be a general positive for, like I said, some of the international assets. That would be positive. If the dollar were to fall, that would make non-dollar denominated investments worth more. Like I said earlier, it would make it would help our exports. It wouldn't help our purchasing power, and that's something we're going to have to see. We've had really low inflation over the last several years. It's going to be interesting when this money starts to work its way through the economic system, where this ends up, and if we start to see higher inflation in the U.S. from the consumer side. So I think on the consumer side, there's a potential risk we could see some heating up of inflation that we're not used to, we haven't seen in a while. But from a corporate level, it should be mostly, I think, positive across the board. But any other comments from those of you on the panel?
Sure, I might make a couple of comments. So this fiscal package, I think one part of the question before was, is it stimulative? And it really is just to we brought the economy to a screeching halt, and we have to abate that under all costs. And so this stimulus package is to try to reignite that. It's like turning a massive ship, or the Titanic. You just can't turn it around without massive stimulus. In essence, in a $20 trillion economy, just with bringing this down over the last 2 weeks, it's $2 trillion that is just left. And that has to get in immediately just to keep companies alive, just to keep people in their jobs. And so it's both. If we don't get that turned around, then the economy will continue to shrink and rival any kind of depression periods that we've ever seen. So it's absolutely critical, and ultimately turns stimulative when we get all of our people in workforce and everything back. That's the critical thing. Arguably, if it does it well, the long-term ramifications, I think Tim is probably correct that we'll see possibly a weaker dollar. It could turn out to be inflation producing, which is something that we haven't talked about in any meaningful way in well over a decade. But those would all be post-consequences, post-crisis. And we'll just have to deal with that at that time. We need laser-like focus just getting out of what we're in. So hopefully that helps.
Thank you, John. One of the other questions is, are the U.S. money markets safe?
Yeah, that's a great question, and that's one of those assets that we mostly don't think about when we're talking about markets, but that is a big part of our market. Yes, we believe that they are safe. We had a couple days there last week where everything was being sold. Everything was going down at the same time. And that tells you that there was fear and a very high premium placed on liquidity. People were selling stocks, people were selling bonds, people were selling treasuries, they were selling gold. Everything was being sold to cash. And in those few days, some of the money market instruments started to see some declines. One good thing about what's happened in this round of market weakness that's unlike what we saw in 2008 is that the Federal Reserve has been acting much more quickly. In 2008, we had several firms, by the time the Fed had started to act in terms of monetary policy and backing some markets, asset classes, we had several firms that had already gone bankrupt. They're much more proactive this time around. They're very active in markets, And backing the money markets was one of the first things that they started to address last week. So yeah, we do feel like money market instruments, which are short-term, very high-quality assets, will be on the list of things that the Federal Reserve will be looking to purchase, and we feel good about those assets. And any other comments from the panel on that?
No, I think you cover it. It's good.
Okay. Another question is, Spain nationalized its hospitals and healthcare providers earlier this month. How bad would the pandemic have to get before the U.S. would follow suit?
Yeah, I can answer that. I think, nationalizing hospitals, I don't think that is the way. We'll have to get really bad in order for the government to step in and do that kind of move. If you look at the slide that I show you, Spain, I think it's in the critical care, there are under 10 critical care beds per 100,000 of people. And, Spain has a similar culture like Italy. So, all grandparents are living with young individuals, so in the same household. So I think that's why, it's spread really fast there, and they are getting into a panic mode. I think in the U.S., as long as our hospitals, as long as the federal government continues to help our hospitals, as long as we're continue to do our social isolation, as long as, we have all the necessary checks and points in line, I don't think we should have that kind of situation. Now, it's really impossible for us to predict. We think in the meantime, we're not going to have nationalized hospitals. I think if you look at some of the countries that have nationalized industries, it hasn't worked very well. But we'll see. It's pretty hard to predict. Any other person has any other things to say?
Yeah, I'd add a couple of things to that. So one, I think that your chart is telling in and of itself. There's a reason why we have substantially more critical beds than anywhere else. Arguably, China's already nationalized, Italy and other countries. So part of it's economic, but through our private sector and to health, we have more resources for healthcare than any other country in the world. Now, our system was not set up for what we're dealing with. We haven't dealt with this before. We were dealt with what we knew, and we took great care and do take great care of patients. What we're witnessing is it's akin to the mobilization of our force in World War II, from completely unprepared to prepared. And we're seeing it happen day by day by day. You can see it from no testing to some testing to thousands and thousands every day and every week. And that will improve almost as rapidly as the virus is spreading. And so we'll see us get ready from a quality perspective to take care of people. And I think we'll rival what's happening anywhere else in the world. And I think some of those numbers pan it out. And we're not likely to have a takeover unless it becomes really economic. And that would probably be a huge step backwards in the quality of the care for Americans.
Okay, thank you, gentlemen. I've gotten like 3 questions from attendees, and all of them kind of lead to this question. In any negative circumstance, there are losers and some winners. Are there any market segments that offer share or market gain, and are they worth analysis and possible investment? I know we've done some of that in the select strategy, so will you guys highlight some of those moves we've made?
Yeah, Rich, can you take that one?
Okay, sure. I think this may have been sent in, some of these prior to the comments that I made, but there are, as I showed on that slide, there are changes that occur throughout a cycle, and every stock market cycle is different than the one before. And so there are things that you can do, such as we've done just last Friday, and get into several more defensive stocks. We bought Home Depot, we bought Coca-Cola, we bought the biggest manufacturer of French fries, Lamb Weston. We got Netflix because everybody's using Netflix. And so we've done some things that make sense, that add stability to the portfolio, but things will change again. Things will change when the next upcycle begins. We'll start to see what the leadership is for that. I've seen, and sometimes in the past, after we've had hard downturns like this, that investors may go more to quality until they're comfortable. They want to be in the companies that have good balance sheets and that have good managements and so on. And those have another advantage, and that's when you come out of a sharp downturn, companies that weren't prepared, companies that weren't managed so well, companies that were overly in debt, struggle. And so the companies that are doing really well, managing really well, come through it pretty well. We just saw last night where Nike came out with earnings, and their results were much better than expected, and their sales were better than expected. And why? Because they had foresight and they got into online business a lot, and that's been really good. So, I guess what I'm going to say, there's certain trends you see in economic sectors, there's certain trends you see in qualities of companies, and there's certain trends you see in individual companies and how they run their business. And we have to look at all those to position well for the next rise.
Can I add a couple thoughts?
Please.
So another thing to keep in mind is sometimes we have a tendency to say, okay, what can we invest in to capture the best returns on the way out? First and foremost, all of you on the call and all of our clients, they come to us, with their serious money for them to be able to live on and do everything they want to do in their lifetime. Speculation and undue risk is not really part of the equation. So to give a little context, as some of what this crisis is dealing with on the front end, we saw areas that we knew would be very difficult. And so Rich and Dave and team, we diminished our positions in energy just a month and a half ago, where we had some cyclical companies that are very quality companies, and they have been, but we knew that they would be hit hard, like Carnival Cruise Lines or Delta Airlines or something like that. It was clear that they were going to run into trouble as this virus became clear that it was something more than what we could have envisioned 2 months ago, say. And that saved a lot of capital, and it went to cash, and we thought about sustainability for the long term. Now, a week ago, Wednesday, I think Carnival, their stock had gone from like $20 to $8. And you can make an argument at that time that it had a lot of upside. It needed a bailout. It needed government assistance to stay alive. Today it's probably trading in the $13 to $15 range. You could have doubled your money in a week, but that would have been inappropriate and speculative for most people to preserve, protect their wealth so that they can live the lives that they want. So I do think as we enter that question, it's within the context of what we're trying to get accomplished and preserving, protecting, and growing the wealth so that we can live a life and have the least amount of worry economically that we possibly can. So I just want to add a little context around, as we see opportunities, they're there, but we want to do it in a very, very thoughtful, constructive way. Thank you, Rich.
Okay, next question is, what does this mean for retirees, and how should we view our investments, and what actions should we take now and in the long run?
Yeah, good question. So I think for retirees, especially for those retirees who are utilizing their portfolio and their investments to supplement their income, where they're taking withdrawals from their investment portfolio monthly or quarterly, we want to revisit the asset allocation and make sure that we have enough years, enough time built in to allow stocks to recover. And so we want to see if those fixed income and preservation assets, the bond assets, are positioned so that they can do that, build in time. You know, this has been the fastest decline into a bear market. On average, bear markets require about 1.5 to 2 years to get from peak to trough to back to peak. Some of the bigger bear markets, like minus, say, 45 and minus 50%, like what we went through in 2008, on average, take about 4.5 years on average to get back from peak to trough to peak. So I'm not sure where this is all going to work out, but we want to make sure that your portfolio has enough time built into it to allow us to avoid selling stocks at prices that are not fair. And we certainly don't think stock prices currently are fair. And we want to allow stocks time to recover. So I would say for retirees, we need to review your allocation, make sure nothing has changed in terms of the income that you need, the time frames that we're looking at. And you know, for those that have more bonds or preservation assets than you might need, then you could consider potentially being opportunistic and potentially starting to make some purchases of equities here with some of those assets. But I would say you want to talk about that with your advisor and make sure that you have your your income and basic needs covered with your portfolio. Any other thoughts about that?
Another question that kind of piggybacks on that is, some of the war chest assets in the portfolio, in the bond portfolio, fell in value. Is this a worry?
Yeah, good question. It's what we would expect to happen when the market has gone through such a dislocation as what we've experienced over the last several weeks. Like we were talking about earlier, last week and over the last couple of weeks, we have seen forced liquidations, and that is investors and funds and strategies that would not want to sell at these prices, but they were being forced to sell at these prices. There was a rush to liquidity, and we saw many quality bonds fall in value. We saw that same thing happen in 2008. And actually what happened in 2008 was about twice the magnitude of what we've seen so far in credit markets and bond markets and in fixed income markets. So it's something that we would expect in a market like this. It hasn't fallen as much as it's fallen in past market times of market stress. We have a diversified fixed income portfolio, which means that regardless of whether interest rates go up or down, or the dollar goes up or down, or defaults go up or down, those diversified positions are not going to all be moving in the same direction. So there are pieces of the war chest, the fixed income, the preservation portfolio that have held up very well. There are some other pieces that haven't done well, but that again goes back to the time. We have a diversified set of assets that we can pull from that have held up well, and we just need to build in time for those other positions that have underperformed, and we expect those to recover as well as we see the general market recover. And that same thing happened in 2009. In 2008, when so many of those positions were weak, we saw in 2009, most of those weak fixed income positions had fully recovered by the end of 2009. And that's what we would expect to happen this time. That's very likely as well.
Can I piggyback on that? Tim mentioned earlier about how quick the Federal Reserve has been to respond to things this time around. We've learned lessons from the past, but another really key lesson that we've learned is the Federal Reserve put in stress tests for banks. Banks were loaning like crazy when the last downturn came, and we had real structural problems. As I think John may have said, we had financial firms that just couldn't operate any longer. Others had needed to be purchased and bailed out by the government or bailed out by acquisitions from stronger companies. We're not in that position this time. I follow the banks, and these stress tests have been very severe. They're stressed for the worst case scenario, and capital standards at banks are much higher. They have more capital. I've heard some comments that perhaps as much as twice as much capital on their balance sheets as they had going into the last downturn. So, you know, it's a really tough environment for banks because interest rates are so low, it's hard for them to make any money. But you have to separate that from the strength of their financial resources and capabilities. And I'm grateful for one, that our financial system is sound. I think it's the soundest in the world. Other countries didn't take the steps that we took to prepare ourselves or to act quickly. The U.S. is pretty sound on that basis, so we don't have to worry about a financial collapse, in my opinion.
Okay, gentlemen, it is 12 o'clock, but there's several questions that have been coming in about opportunities. So just real quick, parlaying from that, outside of rebalancing excess bonds into equities or deploying excess cash, where do you see opportunities within equities for potential rebalancing between equities themselves? For example, shifts between U.S. large, small, or international, and what steps should we be taking there?
Yeah, I'll take this and then I'll open it up and get maybe some of the panel's thoughts. You know, these situations that we find ourselves in where everything is falling at the same time, and all equity assets are falling. You know, it looks to us as though virtually every area, other than some of the maybe niche areas or smaller areas that we've talked about earlier, they look attractive and should perform very well. So small companies have led the way down. That's what you'd expect. They are weaker. They have weaker balance sheets and income statements. They've taken the brunt of the bad news over the last several weeks. If this is like other recoveries we've seen in the past, when we do recover, it very well may be that you see some of those more economically sensitive companies lead the way out, like the small companies. But everything has been reduced in this market decline. You know, David Yepes likes to say that the selling that we saw a couple of weeks ago was indiscriminate. You know, even companies that are based on work from home, they fell 20 to 30% as well. Everything was being sold, and so I think there are some areas in particular that are more sensitive, like we talked about, the industrials, the financials, maybe some areas of this consumer discretionary that would do well. But really broadly, we think everything should do well. I think, like we mentioned before, you may find that because we're starting to see some areas in the United States that are now 30, 40, 50% off their highs, we might find some areas attractive there that we didn't find attractive maybe a few months ago. So I think rebalancing within the equity portfolio can certainly happen, although we probably feel like everything should do well from this point. But John, Rich, David, any comments on that?
Let me just add a little bit to that. So, you know, if you are in the market and you're an analyst right now, you had the 2019 data and data look good. And then you look at the 2020 data and you don't have anything. You don't know what's going to happen in terms of companies. You don't know if businesses are going to go down in revenues 10%, 20%, 70%. Nobody knows. And so in these periods of uncertainty, what portfolio managers and good managers do is to look at companies that have strong balance sheets, lots of liquidity, competitive advantages, that have loyal customers. So you look at the metrics that make a company sustainable, and that's, you know, you have to look, it forces you to look 3 to 5 years ahead because you don't know what 2020 is going to bring. And so, you know, I was talking, you know, I said before that everything sell off, but I think this is an opportunity to upgrade your portfolio to those companies that have those criterias. And if things get worse, they will help you on the downside. And if things get better, then you will be okay because they are the leading companies in their own industry. So I think, you know, a lot of analysts are scratching their heads right now. They don't know what kind of targets to put on all these companies because of the uncertainty. But I think that's how you have to look at things and position yourself for this market.
Okay. Well, looks like we're at 12:05. I know we probably have a few more questions outstanding. So at this time, we'll go ahead and wrap up. Any questions we haven't answered, we'll get back with you via email. But we definitely appreciate your time. We've definitely enjoyed having this, and appreciate that you took time out of your day to participate in this call. If you have any other questions or thoughts about your portfolio or how it relates to what we've talked about today, please feel free to reach out to your advisor and set up a time to speak with them or meet with them and review where you are and potentially how you might incorporate some of the things we've talked about today. So thank you very much again. Look forward to hearing from you all, and hope you have a great rest of your week.